Tell me what are you struggling with, and tell me, okay, if you have an asset realization, what first way, how are you recording the transaction? Let's say, for example, we sold a vehicle worth 130,000 and depreciation is 10% at diminishing balance method, a diminishing method. And this asset, we bought it, let's say, for argument's sake, in June 20, let me just say 2023. And today's date that we're selling it is, let me say, January 2025. And then the accumulated depreciation on this asset as at, let's say, for argument's sake, our financial year starts on 1 March. So it means on 29 February, the accumulated depreciation, let's say 2024, was 55,000. Okay. So how do you deal with this transaction? What's the first thing that you do? Or if you do, you record the notes, because I gave you the steps on how to deal with an asset realization to say step number 1, what do you transfer? Do you remember?
No, I don't. Did you give us the notes?
Yes, I did. When we were doing this asset realization, I explained the steps of how to account for. I think we did it last week. Should be last week.
Yeah, I think you're right, but I wasn't present on that class. Was I? No.
Yeah, because I think we did it last week, and then I sent the recordings on the groups. Okay. So when you're dealing with an asset realization, either it can be a vehicle, it can be an equipment, it can be furniture. Step number 1 is to transfer the cost price. Transfer cost price of asset sold. Of asset sold. Let's say, for example, as we said, it was a vehicle. So in our company, we had vehicles to the amount of 500,000, just for argument's sake. And then now we got to sell one asset which was worth 130, which means, do we still have 500,000 worth of vehicles in our account, or it's going to drop or decrease? What do you think?
Sorry, please repeat your question.
I'm saying, let's say, for example, we had 500,000 rand worth of vehicles in our business, and then we get to sell one vehicle for 130,000. What's happening to our vehicle?
It's going to decrease.
And how do you decrease?
Minusing 130 from 500.
Okay, which means you are crediting 130, right, on the vehicles.
Yes.
Okay, so which means the first thing, if you are crediting vehicle, then this amount needs to go somewhere also, because remember, with accounting, what you do on the left, you do on the right. There's always a transaction affecting each transaction. So now, by us removing this 130 from vehicles, we're taking this 130 to asset realization account. So which means we are debiting what? Asset realization, and crediting the asset sold, which is vehicles. This is the step number 1. Do you understand? So which means once you decrease it from your vehicles, you come on the debit side of asset realization, and then you record the vehicles. And then you record 130,000. And then here it's going to be what? Asset realization. Do you understand?
Yes, so far I understand.
Okay. Then step number 2 you have to now transfer the accumulated depreciation. But before you transfer it, you need to first check if depreciation is calculated. Check if depreciation is calculated up to date of sale. If depreciation is calculated up to date of sale. If not, then you need to calculate it and account for it. Then the next thing that you will do is transfer the accumulated depreciation to the asset realization. So what you do here, you debit accumulated depreciation, and then you credit your asset realization. The reason being, accumulated depreciation has a credit balance. You know that, right?
Yeah.
So which means we need to remove the accumulated depreciation of this vehicle on the remaining vehicles that we have because we're no longer using it. So which means by removing it, you simply debit your accumulated depreciation. And then once you debit, you come again, you credit your asset realization. So here it's going to be accumulated depreciation. But since we haven't calculated it up to date of sale, you now need to calculate it. So you say 10%. We know that we have two types of depreciation methods that we deal with when it comes to accounting. We have the cost price method, which is basically percentage times cost price times N, which is your months over 12. And then we have the diminishing method, which is your percentage times open bracket cost price minus accumulated depreciation close bracket times N over 12, which is the period. So since here we're dealing with a diminishing method, you say 10% times open bracket 130,000 minus 55,000. And then now we need to count the months up to the date that you actually sold it. So the last calculation of the accumulated depreciation was on the 29th of February 2024. So now we need to count up until January to see how many months is it. So it will be March, April, May, June, July, August, September, October, November, December, January. It's 11 months. Do you see that?
Yes.
So now you say times 11 over 12. How much do you get if you punch this in your calculator? How much do you get?
12,000 multiplied by 6875.
6875.
Yes.
Okay. Since you're getting the 6875, which you want to say 55,000 plus 6875, how much do you get?
61875.
61875, which means this is your total accumulated depreciation on that asset we are selling. So you come and write this amount here, 61875. And then step number 3, we need to find out how did we sell this asset? Was it we sold it for cash or did we do a trade-in? If it's a trade-in, how did we sell the asset? So that's your step number 3. Sell asset. So if let's say, for example, we sold it for cash, maybe for argument's sake, let me say 130,000 minus 61875. Okay, let's say, for example, we sold it for 70,000 rand cash. So which means if you sold it for cash, you remember there are two transactions being affected, which the first one is going to be what? Bank, because you just got what? 7,000 in our bank account, right?
Yeah.
And then we come to asset realization. On the credit side of it, we will record what? Bank. And then here it's going to be your asset realization. So this is if we sold it for cash. And then if we did a trade in, let's say we did a trade in and we bought a vehicle with, for argument's sake, let me say 100,000. And then and then they'll tell you, once they speak of a trade in, they'll tell you that the remaining amount is this amount. So if they give you that remaining amount, you just subtract it from the other balance, at which that balance is the one that you record during the asset realization. I don't know if that makes sense.
Yeah, it does.
Yes. So that's what they'll tell you. They'll say they did a trade-in, and for the new vehicle, we are now, for example, owing 55,000. So which means what you do is you say 55,000 minus 100,000, at which you get what?
45.
45, which means we sold this vehicle for 45,000, which is the trade-in. So
Okay.
now this is the amount that you record. Let's say if it was obviously to be a creditor, you record and it will be like you record the amount of asset realization on the credit side. So it's going to be bank if you sold it for cash, or it will either be creditors control or trade payables, and then they will write the name of an in front, and then you record the amount. Do you understand so far?
Yes, I do.
Okay. And then once we are done with this step, now we need to figure out, us selling this asset, did we make a profit or did we make a loss? So if the credit side is more than the debit side, it's a profit. But if the debit side is more than the credit side, it's a loss. So which means that amount here, either the profit or the loss, will be your balancing amount, whereby if this side, if it's going to be 130,000, this side also needs to be 130,000, so that it balances.
Okay.
Do you understand?
Yes, I do.
So once you're done with that, then you're done with your asset realization.
Okay.
Do you have any questions?
No, so far, no. Thank you.
Okay, then okay, that's how you do with your asset realization. The next person, what do you want us to go through?
I'm sorry, before we move on, so asset realization,
Yes.
is it, let me see. Is it for all the assets or is it for one asset?
Mostly if they're given asset realization, they will tell you which asset is being sold. So at the end, it will either be a vehicle, they will record the vehicle. If it's a furniture, they will record the furniture realization. If it's a machinery, they also record machinery. So it just depends with what type of an asset are you selling.
Okay. And then
Yes.
this topic, is it the same as it's PPE?
Well, when you're dealing with the PPE now, it's the block whereby you have your assets. Either if you have building land and buildings, you have your land and buildings, then you have your vehicles, then you have your equipment, and then you have your total. So whereby you have your balance at the beginning, which is a carrying value at beginning, and then you have your cost price, and then you have your accumulated depreciation. And then the next thing that you have is it asset sold? Let me just quickly check. Okay. So you have your carrying balance at the beginning, and then after that you have your cost price, and then after you have your accumulated depreciation, and then afterwards you have your what? Your asset sold. The asset sold. Let me just check. Okay, yeah. So it's your carrying value at the beginning, cost price, accumulated depreciation, and then you have your additions, and then you have your disposals, the asset that you sold, and then you on that disposal, obviously there will be a cost price of that asset, and then the accumulated depreciation, and after that you have your depreciation for the year, and then carrying amount. Let me just make space and do it here. Okay, so I said we have carrying value at beginning, then cost price, then accumulated depreciation. Then we have your additions, which we bought, and then you have your disposals if we sold an asset. And then you have your cost and accumulated depreciation. And then after that, you have your depreciation for the year. And then the next thing you have is your carrying value at end, and then your cost price, and then accumulated depreciation. So this is basically a PPE, at which is very easy. They would give you or tell you if either you're dealing with a machinery or a vehicle, they will tell you that at the beginning of the, or they'll show you a T account that shows at the beginning of year how much of the cost price you have on that asset, and then also how much the depreciation, and then cost price minus accumulated depreciation is equals to carrying value. So which means that's the amount that you record here, basically saying cost price minus accumulated depreciation. And then on additions, let's say during the year we ended up buying another vehicle for a certain amount, you record the amount there. And then the disposals is, for example, that asset realization we just did, whereby we sold an asset. How much did you sell it for? That's the amount that you record here on your disposals. And then the cost price, you record the cost price of that asset, and then the accumulated depreciation that you calculated. So let's say, for example, on that one, the asset's cost price was 130,000, and the accumulated depreciation, you said it was 61,875. So it's going to be 61,875. And then you say 130,000 minus 61,875, you get 68,125. And then you go to depreciation, when depreciation of remaining assets. Remaining asset, because obviously once we sold an asset, let's say the vehicle, and we said we had 500,000 worth of vehicles, but we can no longer at 10%. Calculate this whole in one calculation and find the accumulated depreciation. Why? Because either a new asset was bought, or new asset was, old asset was sold. So now we have three types of doing asset, at which we'll now say 500,000 minus 130,000. And then also on accumulated depreciation, we will remove the accumulated depreciation of this asset we sold, because that accumulated depreciation is no longer part of the assets that we now have in the business. So it means you calculate the remaining, and then you calculate for the one sold, and then you calculate for the new asset. Accumulated times open bracket the cost price of that asset you bought minus 0 because it's a new asset. Or now you say, when did we buy this asset? And what is our financial year end? You calculate up to that period, and then you get your depreciation of new assets. At which our depreciation for the one asset that we sold, you already calculated, and we got what? 6875. So which means this will be our depreciation of assets sold, and then you calculate for the months. Once you calculate all the three, then you record the depreciation right here, and depreciation is always in brackets. Cost price now, it will be your cost price at beginning minus cost price of asset sold plus cost price of new assets to get your cost price here at the end. And then accumulated depreciation, you simply add your accumulated depreciation that you got from the assets, remaining assets, and the new asset, and then you record it in brackets, and then your cost price minus your accumulated depreciation will give you the carrying value at end. So this is basically your PPE. I don't know, does that make sense?
Yeah, it does. Yeah, kind of. But yeah, I'm looking at like it's a very old question paper that I'm looking at. But yeah, it's exactly like how you have it.
Yes, this question is very easy. They won't ask you in a crazy way. Just know the format of it, and also just sorry.
No, I was saying your network is a little bit scratchy.
Okay, can you now hear me?
Yeah, now I can.
Okay. I was saying just know the format and also how to calculate depreciation and know the formulas to depreciation. Once you know that, you're good to go. This question is very easy. It's not really stressful.
So that's PPE in summary.
Yes, that's a PPE. That's a PPE. It's very easy. Most of the things you're already given, so there's nothing much. The only struggle that you have that might confuse you is the calculation of the depreciations, either for the old asset, the new asset, and the one we sold. At which once you get that part, everything is easy. So for the asset sold, I already showed you from the asset realization machine account, how do you calculate for asset sold? And then for new asset, it's very easy because the asset doesn't have, depending on the depreciation method you're using, the asset doesn't have an accumulated depreciation, which means if it's the diminishing balance, the accumulated will be 0 because we haven't calculated depreciation on that asset. If it's the remaining assets, you just subtract the accumulated depreciation of the asset that we sold and also the cost price of it. So which means that's why I said on 500,000, you say minus 130. And then on whatever accumulated depreciation we had at the beginning of the year, we subtract with the one for the asset we're selling. And then after that, when you get the difference, that's the amount you use to calculate your accumulated depreciation, which will be 370 minus 370,000 minus the amount that you get here. And then it's going to be times 12 over 12 because you used these assets throughout the year. Then you get your amount. Do you have any questions?
On this, no, I'm fine, thank you.
Okay. So, what you can do is, from the information that I gave you, try to do the PPE that you saw or that you have, or if you can send it to the group, let everyone do it. And then whoever guys are not understanding, you ask in the group, and then I'll assist you. And then if we have to, we can also go through that question paper once you have, the PPE, once everyone is done it as well, so that we work on what's challenging and what's confusing you. Is that fair?
Come again?
A good idea.
Yes. So just send the question to the group and then let everyone do it. And then tomorrow we can go through it and then we can see where are you struggling, where did you get lost, and where do you need help on.
Or must I send the specific question paper that I was looking at?
Yes, just send it to the group and then everyone will do it.
Okay, I'll send it after this class.
Okay. All right. Okay. So besides the PPE, what else do you want us to browse through also?
For me, I will say it's the VAT account.
Okay, the VAT account. Where are you lost on the VAT account?
I think if you can summarize it the way you just summarized this asset realization and PPE. Yeah,
Okay. Okay. So when it comes to VAT, we have two types of VAT. We have VAT what?
input and out.
Input and VAT output. But I don't think they'll ask you this question since it was also on your assessments, but we can go through it. So we can start off with VAT out, at which VAT output is a what? Credit balance. So your balance at the beginning will be on the credit side. Balance at beginning, which is your balance BD, will be on the credit side. And then you go to your cash receipts journal, you calculate the VAT on the cash receipts. If they tell you it's inclusive, VAT. If it's inclusive, you say 15 over 115 to get how much is the VAT amount. Let's say, for example, they said we sold a vehicle, we sold or we bought, no, yeah, VAT is output. We sold inventory worth 5,000, and then this 5,000 is inclusive to VAT. So if you want to find out how much VAT is in this 5,000, you say 5,000 times 15 over 115, and then you get the VAT amount. But if it's not inclusive, you say 5,000, and then you also get your VAT amount. So that's what you do. You go to your cash receipts journal, you calculate your VAT, and then once you get the amount, you record it on the credit side as bank, which is your CRJ. Then you record the VAT amount over here. And then also you have on your cash payment journal, you will have your trade payables control account, at which this, for example, is for when I don't know which example can I use. It's for, like, for example, when we get or we gave a discount, because remember, if you give a discount, it becomes the opposite. Now we are the ones who have to pay that VAT on that discount. So it's the same thing as here, and then you record it as a what? Trade payables, which is in the cash payments journal. And then you have your trade receivables, which is also in your what? Your sales what? journal. So on your sales journal, this is all the sales that happened throughout that business period. So you need to calculate to see how much VAT was there. Let's say, for example, throughout we had 70,000, and then if it's VAT inclusive, you do the same thing. You say times 15 over 115 to get the VAT amount. Once you get this VAT amount, is the one that you come and record here. And then that will be it on the credit side. And then we go to the debit side. We will have, because remember, in a business, you have clients that will return goods, either they may be damaged or the wrong quality or whatsoever the reason is. So on the credit side, you record your sales returns. And then they'll give you the amount of the sales returns. You do the same thing, you calculate your VAT amount, and then you record it here. And then your balancing figure will be what you call the VAT control. So this will be the balancing figure of this plus this plus this plus this. Obviously, it's more minus this to get this amount. So that it balances. The amount that is on the credit side should also be on the debit side. Do you understand?
Yes, yes.
Okay. And then let's proceed to VAT input. VAT input is also one and the same thing. So which means the opposite of what VAT output, meaning to say our balance at the beginning is on what? On the debit side. And then, yes, and also we have bank, the amount that we paid, which will be from what? It's just one and the same for me. It's just like everything like that's on the debit side, on the credit side of a VAT in our VAT output. Now it's the opposite of it. It's now on the what? The debit side of the VAT in. So it's the same thing, bank, CRJ, and then you have your trade payables, and then you have your trade receivables. You understand?
Yes.
So which means your trade payables, it will be what? Your purchases journal. No payables, I mean pay here. To be a purchases journal, and then you go to your credit side, it will be purchases returns. And then you have your VAT control account, which is the balancing amount. This purchases returns journal. And then you balance it off. The amount that you have on the debit side should also be the amount on the credit side. Just go through the VAT class that we did, and then you see the format and it becomes easy for you.
Yeah, I did. And then I think there was some disagreements there. I think, okay. And then so now, okay, so how will the VAT control account look with these two
The VAT
from
control account.
Mm.
Okay. So we have a VAT control account. So now this is the VAT control account is like the account that's having both the what? The
input
VAT
and
input and VAT output in one transaction, because now we are balancing off the two. Okay. So now on the VAT control account, we first look at our VAT input and our VAT output to see which amounts were debited and which amounts were what? Were credited. So for example, if here on the VAT input, we had what? Credited the VAT control account, which means this side, the VAT input is gonna be where? On the debit side. Do you see that?
yes.
And then the opposite, also we go to our VAT input. The VAT control account was what? Debited. So which means on this side, because basically the VAT control account, we are trying to, okay, I don't know. Oh yeah. trying to move this thing. Let's see. Yeah, okay. So basically with the VAT control account, we are trying to balance off to see VAT input and VAT output, which one is more, so that we can get to see, do we owe SARS for VAT or does SARS owe us for VAT? So that is the difference that we'll be trying to figure out to say, is our VAT input more than our VAT output, or is our VAT output more than our VAT input? So that we balance off to see, at the end of the year, do we have VAT control account as a trade payables, or do we have it as a trade receivables? Do you understand? But mostly they won't ask you questions on the VAT control account.
Okay.
It's either if they're to ask you, it's either the VAT input or the VAT output. For you to draft a VAT control account, I've never seen it. I've never seen them ask for it.
Okay. But yeah, I wanted to know, how do you balance it off?
All right. No, that's basically easy. You just deal with it as I showed you. Do you have any other questions?
That's it from my side. Thank you.
Okay. Okay, does anyone else have a question? Does anyone else have a question? Yes?
If no one has a question, can you summarize back Recon?
Then click on, okay. So, I think that's what I had put right here. Where is it? Let me just do this. So your bank recall, it will be something like this, whereby they will give you amounts. So it's question 2, whereby you have your bank recall, and then they give, let me see. And then you have your cash receipts and cash payments. And then also you have your bank recall and your bank. So they'll give you subtotals or opening balance of either the cash receipts or cash payment. Okay. So if, for example, here they told you that the subtotals of the cash receipts journal is 224,660, and then the one for cash payment is 216,020. So you just come and then you record the amount here, 224,660, and then on cash payment you record your 216,020. And then now you go to your question paper, you now check to see, they'll always tell you that some transactions occurred on the bank statement but were not recorded in the cash journals. So now you figure out, or you check to say that transaction that was omitted or that is not yet recorded in the cash journals, is it being recorded in the cash receipts or is it being recorded in the cash payment? So we go to our additional information. Here they say the following appeared in the cash journals but not on the bank statement. So if things appear on the cash journals but not on the bank statement, they are recorded in the bank record. But if they occur in the bank statement and not in the cash journals, they are recorded in the cash journals. Now you just need to figure out and see, is it a cash payment journal or is it a cash receipts journal? So here they told you that there was an outstanding deposit of 3,000, and then EFT for 1,500 to NCA for stationery purchased. And then the EFT number 210, 212 appeared on the current bank statement for December 2024. So mostly what happens is we have transactions, like for example, a business may have its financial or monthly date ending on the 31st or the 30th, but the bank would have sent the bank statement on the 25th. So there are transactions that will happen from the 26th until the 31st that the bank will not have. So how do we notify the bank on these transactions? We record them on the bank Recon and then send it to the bank, and then the bank can check and then add those figures. So when you get, let's say, for example, we're in October. Now we're going to November. When we get our bank statement for November, those transactions should be on the bank statement to show that the bank has written or has what? Rectified or not rectified, but they have also added those amounts or figures or transaction on their side as well. Because, for example, the bank recon is just us trying to balance off the business books and the bank to say, if our business book saying that we have 50,000 rand cash in our bank, the bank also needs to have that same figure so that you know that things are balancing. But at times it may not always be the case because such issues of the bank statement might be sent earlier before the business closes off its books for that month, whereby the statement might be sent on the 25th, but you have transactions that you okay from the 25th until the month end, which is like the 31st or 30, that the bank will not have. I don't know, does that make sense?
Yes.
All right. So now you need to check. As here you can see, it said EFT number 210 and 212 appeared on the current bank statement for December, which means they have what? Recorded these two in the bank statement as well to say we have seen this transaction and we have recorded it on our side. So which means you just tick it off. It's now done and dusted. And then the next thing, they said the error made by the bank during November 2023 was corrected on the bank statement for December 2024. The error made, which is what? This one, correction of error. They have rectified it. So which means we do nothing with it. And then you proceed, it says the outstanding deposit 205 does not appear in the current bank statement for December 2024. So if it does not appear in the bank statement, you record it again in the bank record until the bank has recorded the transaction on their side. So if they did not record it on the bank statement, you record it again on the bank record to show them that you have left out this transaction on your side as well. Do you understand?
Yeah.
Okay. Then we proceed, and then it says an EFT for 3,550 was reflected in the Kulong Traders bank statement. This payment was not made by Kulong Traders, but by another client of the bank and must be corrected by the bank. So what may happen also in the business world is maybe you may have your business as, for example, our business was what? Let me just check. It was Kulong Traders with an H. There may be a business which also has the similar name but does not have what? An H. So what may happen, the bank may sometimes make mistakes whereby maybe this business paid a certain supply or a certain credit on their side, and then the bank mistakenly takes that money from our business bank, which is an error due to maybe we might have similar names. So now if this happens, we need to record that error in the bank record to say the bank needs to rectify this error. That transaction is not of our business. You understand?
Okay.
This is what they're talking about right here. To say an EFT for 3,550 was reflected in the Kulong Traders bank statement. This payment was not made by Kulong Traders, but by another client of the bank and must be corrected. So you see, they're telling you that it was another client. Maybe that client maybe had a similar name to that of our business. And then instead of removing that amount from this client, they took it from our side, but at which that transaction is not in our business. So which means we need to show the bank so that they rectify and give us the common money. You understand this one, right?
Yeah.
Okay. And then you go to number 5. Number 5 says a stock order for 800 in respect of the insurance paid to insurers Ltd was cancelled on 13 November 2024. The amount was erroneously entered in the cash payments during December 2024. So if this amount was recorded in the cash payment and we had cancelled it, which means cash payments are dealing with money coming out of our business, right? We
Yes.
agree?
Yeah.
Okay. So which means to rectify this error, we need to record that amount on what? To bring back our money on the cash receipts. Do you understand?
Yeah.
Okay. Any questions so far?
Mm-mm.
There are no questions. Okay. So if there are no questions, then we proceed to the next one. The next one says EFT 215 for 4,300 appeared twice on the bank statement. So if it appeared twice, it means the bank what took 4,300 twice in our bank, right?
Yes.
So how do we record that? How do we rectify such an error? Are we the ones who's able to rectify this error? Or it's okay, let me ask you in this way. Do we have any control as the business to rectify such an error, or we have to send it to the bank and then they rectify it themselves? Because remember, we have no access to the books of the bank. So which means in whatever error that happens, if it's in terms of the bank, we have no authority but just to send either the bank record to say you have deducted money twice on this transaction, and so that the bank can rectify that error and pay the balance back. You understand?
Yeah. Yes.
Okay. So which means this one will be recorded in the bank recon. And then number 7 says an EFT payment to solid traders in settlement of our account 4,350. The bookkeeper incorrectly entered the amount as 4,530 in the cash payments. If you can recall from the last classes where I told you about an overcast and an undercast, do you still remember?
Yes.
So this transaction is an overcast or is an undercast?
Overcast.
Okay. So what did I say when it's an overcast? What do you do?
I'm just thinking you bring it back to the receipts.
Okay. So if it's an overcast, you record it on the opposite journal. So if, for example, this error is an EFT payment, which means it was a cash payment journal, right?
Yes.
Whereby we were supposed to pay 4,350, but our bookkeeper mistakenly recorded 4,530, which means there's a balance of 4,530 minus 4,350 of 180 that is more, which means our bank is less 180. So which means we go to the cash receipts journal and then we record what? That 180 back as what? We will record the name of the, you say solid traders. Either you can record it as an overcast. So you're adding this 180 which was over back to the bank in the cash receipts journal. Do you understand?
Yeah.
Okay. So which means here on the cash receipts, you record solid traders and then you record the 180. And then that other 800 for insurance, you record it here. Insurers, what is the name of the company, and then you balance off right there. And then you proceed to number 8. Number 8 says a debit order for the monthly office rent 4,500. The transaction had not been taken into account in the cash journals. So we are paying we are paying rent on the premises that we are using to operate our business. So if it's a payment, you go to cash payment journal, and then you find out it's monthly 6, then you record the 4.5. This one is easy, right?
Yeah.
Okay. Then after that, you move to number 9. Number 9 says Cologne traders made an EFT payment of 9,652 Qualixia traders, the bookkeeper incorrectly entered the amount as 6,950 in the cash payment journal, which means this one is an undercast, right?
Correct.
Right. So you find the difference. You say 9650 minus 6950. The difference, you come and record it on your cash payment as an undercast, and then you record the amount there. And then what's the name of the company? It's Qualixia. So here you record Qualixia traders, and then you record the difference in the same cash journal that it occurred, because it's an undercast. So you record it in the same journal.
Yes.
Do you understand?
Yeah.
All right. Then we proceed to number 11. Okay, so these are the bank charges. You just simply add all three of them. You go to your cash payment journal, you write off bank charges, then you put the balance of all three. You add them as one. So you say 355 plus 125 plus 485. The amount you get there, you record it here as your bank charges. And then you add, you find your balance. Any questions so far?
Where's your bank charges?
Any questions so here?
Oh, yeah.
Here's
no,
annual
sorry.
service fee, internet service fee, and deposit fees. They are all bank charges. You add them, all three of them.
Okay.
The only one that you will not add if there was a bank overcast, no, overdraft. This one is not a bank charge, so you cannot add it as part of your bank charges. Record it separately on its own.
Okay.
All right. And then after having done that, they told you that now you go to your question. You can see unfavorable balances per bank account. It's on the what? Credit side. Do you see that?
Yes.
Which means if it's unfavorable, we go to our what? Our bank, which means our balance be due will be on the credit side because it's a negative amount, which means here it's going to be 0. And then here on the debit side, you record all transactions that were in the cash receipts as total receipts, which is your cash receipts journal. You record the amount here, and on the credit side, it should be total payments. And then you choose your what? Cash payments journal. You record the amount there, and then you find out which is more, or what's the difference. If the debit side is more than the credit side, which means the balance CD will be on the credit side. If the credit side is more than the debit side, which means the balance carried down, it will be on the debit side. So if it's more on the debit side, whereby we have a balance CD on the debit side, it means that our what? Our bank again is going to have what? A negative figure. But if this side is more like we need the carry it down is this side, this side. So which means if you say this plus this plus this, it must be equal to this, and also must be the same amount. Do you understand?
Yeah.
Okay. Once you're done with your bank, if let's say, for example, it was on the credit side, you go to your bank record, balances per bank account will be in brackets because it's a what? It's a negative figure. But if it's a positive figure, you record as it is. And then on your outstanding deposits, you go back to your question. They told you that the outstanding deposit 205, which is this one, did not appear on the bank statement. And then on top of that, they told you that there's another outstanding deposit of how much? 3,000. Do you see that?
Yes.
Do we
Where's
all
the
see that?
3,000?
Okay.
Oh, yeah. Number 2. Okay.
Here.
Yeah.
Which means what we do is we add the two of them to find out how much do we get. So 7,500 plus 3,000, I think you get 10.5.
Yeah.
Which will be your what? Your outstanding deposits in You record it, 10,500. You record the amount in brackets or you put a negative figure because it's a credit balance. And then on outstanding payments, you go back to your questions and then you check which payments did they say that did not appear on the bank statement, and then you add those. Do you understand?
Yeah.
Okay. So once you get them, you record them as a positive figure because payments have a debit balance. And then after that, you go to your errors, the errors that you made. Remember, there's that 4.3 that they took twice. You remember? This one.
Number?
Do you all see it? Number 6. Do you see it?
Yeah.
Right here.
Yes, yeah. Appeared twice on the bank statement.
So which means one of it needs to be rectified. And then you go back. There's another error that they told us that the bank did not rectify. The error made by the bank during November 2023 was corrected. Okay, so this one is fine. There's another one that they said, let me see. Yeah, this one, whereby they took this money and it was not part of our transaction. Do you agree? Or number 4? 4.
The incorrect, okay.